Hey, Think Realty, thanks so much for being a part of the podcast today. It's our privilege and my pleasure to host it. As the founder of Think Realty, I founded this in 2013 for real estate investors. They're trying to find their way. I'm a third generation real estate investor and found so much opportunity in the marketplace, but found so many people struggling to just find connected dots to get to that success. So that's what this podcast is all about. I've got a great guest for you today. But before we get to the guest, let me say a quick thank you to our sponsor for the podcast. This episode is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. Our guest today is Bill Tessar and with CV3. Good to have you on the show today.
Thank you, Eddie.
Yeah. So your world has been changing a lot, but so has the marketplace. So if you don't mind, just give our listeners and viewers a brief overview of you and CV3, and then we'll get into maybe some conversation about the marketplace.
Yeah, so, you know, CV3 is really, was really born off the heels of Civic,
right,
and what took place there. And right, we started, I think, September 1 of last year, 155 of us. That's now 215, I think, is what we've grown to. Really focused on the same type of originating that we did back in the old co. On the BPL side, it's DSCR, bridge, and bridge with reno, and construction as well. You know, I think the motivation for the group is to get the belt back. We're not there yet, but crossed our first billion, yeah, which we were excited about.
Congratulations, that's awesome.
Yep, thank you.
Right at about the year mark, right?
Just in front of it. It is kind of funny, like, it's a big number, but when you were doing 3 billion, yeah, that's the number that is in all of our heads. So the celebration lasts about a moment. Everyone pats each other on the back, and then it's like looking at the pipeline and what's coming down the.
Let's go.
Yeah, it's so yeah, we're excited about it.
That's awesome.
25 will be a big year for us.
You know, before we jump into kind of conversations on the market, what is it like to start a company with over 100 people? Because most people, you know, when you're starting a company, you're starting with, you know, 5 people, 7 people. You started a brand new company. Was there challenges with starting something brand new but with that many people? Or was it just a good transition because a lot of them are coming from the old co?
So I'll answer it 2 ways. The first way, we'll talk about the fear part. When you have 155 payrolls and benefits for 155 people.
It's a lot of people.
It is. Yeah. And we started with not one loan in the pipeline.
Yeah.
And so you know you're going to have burn. And so like in my seat, it's like, how long are you going to burn and how much are you going to burn before you cross over? And and I always looked at enterprise value a certain way. Having been involved in the sale with PacWest, I knew what that company looked like at the time we sold for that amount. So in the back of my head, I gave myself a little bit of runway to burn cash while we get up to scale. So was it scary? Sure. Did I think about it every day? No. I did think about it, and when I went and raised capital, we had those discussions, of course, right? Because the smart people in the room were like, do we need 155? Can we start with 10? But we needed 155. And the way I looked at it, Eddie, is we left 350 back. We had over 500 employees when we were at 3 billion. And so, like, I've never felt like we were able to take all of our team members day one. And in the back of my head, you know, part of the motivation of growing this thing is to continue to add some of those folks into our organization. But yeah, I mean, a little bit of fear, but not a lot. Yeah. And it's kind of proven itself out a little bit.
It definitely has.
Yeah.
Yeah, it's funny. There's a book by Horowitz called, I think it's Why Hard Things Are Hard. He's a VC investor, and he says oftentimes we're looking for the one silver bullet to win the war. He said, really, we just need 10,000 lead bullets, and it felt like he kind of like went in it with 10,000 lead bullets. Like, let's just throw everything at this thing and get it off the ground, which is cool. It's cool that you were in a place to do that.
Yeah, you know, I think what happened with Oldco and how it ended didn't just impact me. It impacted so many people.
Sure.
individually and then organizationally.
And industry-wide too, by the way.
I think a little bit of that. And it did create a why. Like a lot of books written about your why. What's your why? What gets you up in the morning? We have an army of people that have a why that very few organizations have. And that can't be taken away. So I do think, like, if you're looking for the silver lining, there were so many great things that came out of that tragedy. So many great things that I'd never experienced in 40 years. And so I do think that it's also a huge competitive advantage. If you're not winning in price, you're not winning in product, you're not winning because you close loans in 3 days, you better win with people. And so that's kind of our superpower.
Yeah. So good. Obviously, we've got a time set aside at the AAPL conference coming up, but let's make it more direct towards the real estate investor. You have so much insight into the market itself. And maybe just, for an explanation for the mom and pop real estate investor who has 4 or 5 or 10 rental properties, could you explain kind of where the capital is in the marketplace today, where it's coming from, what its desire is, and then maybe how because you kind of do it a little bit different than a lot of people. So like, would you kind of explain, your theory, your, kind of mantra as to how we use the capital and the capital markets in Main Street for real estate investing?
So you're talking about the business purpose lending part, right?
Yeah. Business purpose lending.
One of the big aha moments for me, Eddie, and I don't know if it was for you, but I spent 30 years on the conventional side, and people would argue over $30 credit reports, and an eighth mattered. And when you're dealing with professional business folks, there's an opportunity cost of capital, but the dependability of it being there and showing up on time, and the leverage, and then the rehab component, I think is game-changing stuff. So here's my answer to your question. I believe long-term rates come down. I believe they have to come down. Let's just forget inflation, recession, who's in office, who's not in office. They have not created any new home buying products for the conventional home owner-occupied borrower. They haven't created anything yet. And rates are stagnated in the high 6s, low 7s. So I think long-term rates come down, which is good on the exit side of for our investors. What a lot of our investors are doing is they're just holding the property, renting it. Rental rates are still good, high 6s, low 7s. You could cash flow on that. And then as these rates come down, and they will, I think the opportunity is going to be huge, and you're seeing a plethora of capital from the insurance companies and the like coming into our space. You've got rated securities now on RTL, which is something that people are pretty excited about, and then the DSCR securitizations have really taken off. So that's pushing the cost of capital down, allowing folks in our space to make a little bit more spread. And then to pass that on to the borrower. So I actually think there's more capital on the sidelines than there are borrowers to borrow it. That's what we're seeing. All of our discussions with our senior lenders, our takeout lenders, it's being pushed down. Advance rates up, margins and step downs down. Everything about the financial structure that we're experiencing is better. Which I haven't been able to say that for a long time.
It seems better. It also seems like it's going to be better for let's just say the borrower, the investor, who is rehabbing houses and finding these properties that are still within margin to create rental inventory and things like that. I read a stat the other day, said there's roughly, this was a NASDAQ stat, which is interesting, but it said $340 billion in liquidity is earmarked by banks and institutions specific for business purpose lending with an anchor in real estate. $340 billion in liquidity. I assume that that's kind of like across the board. And so I asked a guy that's kind of in the capital markets, I said, you think that 340 billion is accurate? He said, I think that 340 billion got deployed. I think there's another 340 billion behind it, because he was like, there's so much liquidity everywhere and no one's finding yield, that this 340 finds yield. There's another 340 behind it. Is that kind of the sense that you get?
You got equity in the transactions. You got borrowers that have skin in the game. You have big coupons, and it's performing. It's like if you and I are figuring out a way to put our money, why wouldn't you be putting in that? And then you have the appreciation. You got all the other tax advantages of cost seg, and so I think that what we're seeing is more per investor buys today than we have ever seen. So if I had my top 50, my top 50 investors are buying more per investor than ever before.
Really?
Yes.
Interesting. As it relates to real estate investors, is there a certain segment of the marketplace that you're bullish on? I know that there's been some lenders here as of late that have just taken a bath on multifamily, have taken a bath on these build-to-rent communities. Is there any that you're like kind of bullish on? Like, I really like the fix and flip. I really like the single-family rental market. I really like multifamily. Like, is there any that you just see like, man, this next quarter, this next couple of quarters, I feel like there's going to be a run?
I appreciate you asking me that question, and this is going to be a very unpopular answer.
Yeah,
but
and I usually go that direction, so I'm good with that.
I know. I like the jumbo market, not the super jumbo. We just did a loan. It was all over the Wall Street Journal. The Kanye deal. Yeah. That was an $18.5 million loan on a Malibu deal, and the characteristics around that were such that we were protected in the loan coming in and going out. But I actually like the market.
Can you tell us what your leverage points were on that one?
Yeah, so that
was the one thing that the Wall Street Journal didn't talk about.
They didn't.
I got you off track. You keep going.
It's okay. So the value came in at, he bought it for 21 and a half. The value came in at 28 as is, and it had an ARV of like 46. Wow. Now remember, Kanye paid 50 some odd million, and what was key to that particular deal is that was an Ando. So like you and I were talking about art, that is the art of real estate. That guy, and they had Marmo Radsner, which was the developer, and they were on the deal, and so the buyer, who we've done a lot of deals for, got the transaction locked up because Kanye was getting rid of a lot of assets, and he ended up getting a hell of a deal on it with the developers coming in and the Ando stamp. So it was $6 million to get it back to what he did. So if you do the fast math, but the 18 and a half was construction down, everything. So it was a high leverage point, but the family office that bought it they own $6 billion of real estate in California, and if it doesn't go well, they would love to have that as a trophy property.
For sure.
And that's like, there's nobody on Wall Street that would have touched that.
No
we funded it. We financed it. We had an exit that had a non-refundable deposit associated with it. I wouldn't have funded it otherwise, but that he stripped that property. I don't know if you really got into that. He literally stripped it right down to the concrete.
Wow, no, I didn't.
But it was in the front row of Malibu, and so I like 5 to 15. Why? You say why would
jumbo, you? So you feel like your definition of jumbo would be 5 to 15?
Anybody else you talk to in this space will tell you their jumbo goes to $2 million.
Right.
We have institutional buyers to 5 all day, every day. 7.5 to 10 if the leverage points are lower. I can make a phone call and make that happen. Once you get above that, it's a real conversation, and you have to have an exit because you don't want a bunch of those sitting on your balance sheet. So I think there's a huge market for that. I got 20 on my desk right now, 7.5 to 20 million.
I'm seeing that in Florida a lot, where we're developing and buying up in the Jacksonville market, because you can still buy a beach house in sections of Jacksonville on the beach, on sand, 3,000-4,000 square feet, 5,000 square feet for about $1.5 million.
How's it possible?
But they were built in the 70s, and they need some serious work. Okay. But you're literally a mile from something that Ed Milet, big podcaster, just bought a mile up the street from that, and it was the most expensive house in that area, and he paid 28 or 32 million bucks, right? It's like there's still a mile down the street, $1.5 million. Like, so I kind of see it too, and also with all the flight of big money coming from the more inflated income markets, New York, California, all moving into these other areas. Texas, you're seeing the same thing. A $2 or $3 million house in Texas is a serious house.
Manhattan Beach, you can't get a tear down.
Manhattan Beach, you're not getting a tear down, right? So that's the thing, is like, but if you're coming from Manhattan, from the U.S. or from the New York, it's like you're getting a small apartment for $2 million.
That's right.
So
that's right.
I see where you're headed with that for sure.
I think, look, it's not what's going to drive CB3. No. All the stuff down the fairway is going to drive CB3, but I think it's 25 to 40 million a month of business there, which is, what is that, 6 to 12 deals a month?
Yes.
I think that's real.
Huh. And probably high margins and good opportunity.
They don't care. And here's the other thing, Eddie. The guys that are borrowing money at that level, if the shit hits the fan, they will solve the problem.
Yeah.
They'll take their licks. They don't make what they thought. They maybe lose a little. They're on to their next trade.
Yeah.
They're not in love and infatuated with that trade. And so I think in all the years I've been on the BPL side, which is 17 on, we've had 2 real jumbos that both had PGs that didn't go well. One was a heart surgeon, and another guy was a trader in New York trying to build a home in Beverly Hills, and the 3,000 miles was a problem for him. Yeah. Those were the only 2 that I can remember, which we didn't suffer any losses on, but I would call them failures. Other than that, I think if you get the equity right, the valuation,
And there's just a level of patience that, so I've done a couple of those deals, and I'm bidding on some right now. And you just have to have a level of patience with those deals. Those aren't things that you turn around in 3, 4, 5 months.
That's right.
That's right. There's got to be some patience. And so if you have a little bit more patient money that's waiting on the upside, it's not a bad deal. That's an interesting take. I've never heard anybody in recent days say jumbos, but I see the point for sure. Well, what do you think about the multifamily market? So many people in our space, they've graduated. They've been with us for 10 years. They're doing single family deals, and they're like, we're going to graduate in this multifamily space. Is there enough blood in the water right now that they should be looking to take down deals, or do you think the market's still going to compress and there's going to be a lot more damage?
I think the market's still going to compress. Like, remember, our old co's original owner was Wedgwood, and that they purchase, fix up, and flip 400 to 500 homes a month, and they were heavy in multifamily. So I do have some color across the nation on that, and I would say that personally speaking, I'm not getting involved in that at this point. I'm waiting. We did about $300 million a year in old co of small balance multi, like 2.5 to 10. So we're not lending on it right now.
And a lot of people aren't.
Well, there's a couple of our competitors that got taken out to the shed on it. So we should all learn from that. That's not to point fingers, because we're all susceptible to those types of things, but we should learn from it, right? What is it? If you don't learn from yours or others' mistakes, you're damned to repeat it. And it was part of our 25 plan 6 months ago. It is off of my plan for 25.
Yeah, I see a lot of lenders moving that way, and I'm finding a lot of multifamily guys, like really seasoned ones, that are struggling to find capital today, even though there are some ripe deals. Like I just got in a deal in Georgia, 60 cents on the dollar, because the guy had a bridge loan that was expired. He had already had, the lender was ready to get out of it. He didn't have enough liquidity to go to long term, but it was already completely rehabbed and 82% occupied. Like, for me, 60
But he couldn't
cents
find financing.
Couldn't find financing because he was struggling. He had this small gap and he didn't have enough liquidity and a strong enough balance sheet that he could get it done. So I got the thing for 63 cents, 65 cents on the dollar. And those are the perfect deals out there, but I'm not seeing them in masses. Like, I'm still seeing people holding on to value, trying to work these deals out, and they won't come off a price. Like, that's where I'm still seeing it.
Yeah.
So that's interesting that you see the same thing, and you're navigating your lending practice that way too.
I think as a lender, it's natural for all of us to want to lend to everyone on everything for all purposes. But I think that it's also very, very important to use the senses God gave us. And if you don't, I think you could be subject to, some of the carnage that we're seeing. And yes, Eddie, if you have the liquidity and the know-how, then there's probably some great opportunities.
There's still few and far between. There's a practice. I ask this question to a lot of lenders, and I think it's a fascinating question because you see most of them answer differently than what they actually act. My question is as a lender, are you trying to be ahead of the curve, or do you wait to be slightly behind the curve and then you jump in as quick as possible, right? Like, are you trying to predict what's happening, or are you waiting for something to happen and then reacting?
So if you think about jumbo, that would be leading the pack. I don't think anyone will follow me.
No.
I think it scares the shit out of people, the jumbo, bigger number, bigger losses, bigger part of their lending capacity. Like, there's 100 reasons why they won't. So maybe I'm a maverick in that I would say I'm a measure twice, cut once guy. So I look around to see what's happening and working and where the money is flowing, and then let that kind of dictate me. I will tell you, the jumbo, I've spent a lot of time with a lot of folks, a lot of untraditional buyers, family offices and the like, and created a credit box that people can get comfortable with because I'm passionate about it. Because I believe in the product. So maybe in that case, but on the other stuff, I'd say maybe a little bit more of a sheep than a lion.
Yeah. I see that as necessary in the lending market, especially when you have, if you're a discretionary lender and you have all your own capital, maybe you could be more aggressive. When you literally are representing everyone else's capital, and your own, it's like, it's a scary thing to jump out there. And I think that's the big differentiator between a real estate investor who is trying to predict where the market is going and trying to get ahead of it versus the capital, which is always just a little slower. And I always kind of try to remind our viewers that just because you have a great idea or you feel like you've got the crystal ball, that doesn't mean you're going to be able to find the capital to go with you. You may see it ahead of time. I've seen it many times ahead of time. You see where the market's going, but you have to wait for some of those pieces to fall before you can really get your capital to line up and actually do it,
Yeah, and I think if you have a history of success as an acquirer of real estate, you'll have more people that'll want to lean into you to be a partner from a financial perspective. I think one of the things that you and I are probably most closely connected on is inventory levels, and I'm just I'm more insane in my position today than I was the last 3 times we've talked, is just no inventory, and that is supply and demand, and that drives price, and all the other factors that people are pointing to is really baloney. Because when you don't have enough of something and you have real need for that something, it's going up in price.
Supply and demand.
It is. It's crazy. So it is, and it's so simple, and I can't tell you how many times I've talked to professionals like yourself that don't get it, and they'll point to like something they read in the Wall Street Journal, which is all baloney, right? Like recession, inflation, interest rates, long-term capital gains, blah, 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 blah. And I'm going like, dude, we're 7 million homes underwater. Like, fix that riddle. And then I'm listening, right? And so, and quite frankly, maybe in my investing lifetime, I don't know if we solve that problem, Eddie.
We will.
Like, I don't know.
I actually think it's impossible because the scale has tipped too far in that direction. The only way, because even just jacking up prices and the marketplace inflating does not solve the problem,
that's right?
Like, it creates more problems. So like everything that's happening, all these measures are happening, is creating a bigger vacuum. And there was times during, let's say the last 6 months, where people said, well, we're only really like 2 million homes underbuilt. It's like, no, if we were ever 7, there hasn't been enough inventory to go less than 7. And so therefore, you might say there's less demand or they can't afford the house. That's a different conversation.
But
different
it doesn't conversation.
Mean that it's available. Exactly, and it's available.
And we've talked about this before, but people are educating their kids at home. People are keeping their parents at home. People are working from home. You have, even from an immigration standpoint, there's a lot of people that need housing. If they're in here legally or not legally, they still need housing. And so that's not even factored into the number. So like in my mind, I know I've seen some of that stuff, Adam, in different reports, 3.5 million, 5 million, 7 million. I think whatever's being reported is low.
It is. It has to be.
So, like this, for me as a real estate owner, I'm a buy and hold guy at this stage. One of our biggest investors, a close personal friend of mine, has been buying real estate since the mid-'70s. He owns $6.5 billion.
Wow.
$6.5 billion of real estate.
It's a large number.
Almost unlevered or no levered. Like,
wow.
And I had lunch with him the other day, and I was just asking him, like, he's like, why don't you sell anything? And his answer is the same one that you and I have. He just shows me his chart from every single price point that he has bought, and it goes like this. And until someone shows us different, and yes, we have the little dip and then up and then the dip and up, but he will not sell.
Once you get to critical mass, there's no reason to sell.
That's right.
Yeah.
And now there's and not to make this about tax and charitable donations and stuff, but there is so many other plays aside from appreciation and aside from cash flow that people are taking into consideration that just makes real estate the best investment in the world.
Yeah. I 100% agree. You heard it here. So, Bill, how can they get a hold of you? How can they find you? What's CV3 website, social, whatever you want to put out there so they can find
so it's CV3 Financial. If you Google that, I'm not real good with URLs and stuff. Hey, great job, Bill. CV3 Financial. We're based out of the South Bay in Southern California. Got offices throughout the United States, and
Yeah.
Appreciate you, Eddie.
Thank
Always.
you. Always appreciate you too. Thanks for being on the show.
Thank you.
Quick last thank you to our sponsor, Real Property Management. This episode is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com, realpropertymgt.com. And if you haven't already started making plans to be a part of our Think Realty Conference and Expo in Phoenix, it's coming up on March 27th and 28th in 2025. Set your sights on making 2025 success by being a part of this conference. It was a great first year in Phoenix last year. We've got an amazing year coming up. We've got some great content. I'm lining up some really great speakers, and you will have a great time. And as always, for a thank you of being a part of the podcast, if you go on and sign up for tickets and use the code podcast, all caps podcast, you'll get a buy one, get one free. You get that BOGO there, and you can bring a guest, a friend, a partner, whomever, and we'd love to see you there. So make sure you're making plans. You can go to thinkrealty.com/Phoenix to get your tickets, and we will see you there. Thanks so much for being a part of the podcast today.